Welcome to Markets Now. I'm Michelle Rook along with Brian Splitt with agmarket.net. Of course, report day, and we are down in all the grains after the report. And Brian, let's talk about soybeans first. Probably the biggest disappointment there, 300 million bushel ending stocks figure, and talk about how we got there.
Yeah, so just for reference, the estimate from the trade ahead of the report was 100 million bushels less than that. So this ending stock number came out big picture pretty bearish compared to pre-report estimates. They went ahead and they cut the export demand by 125 million bushels. Makes sense based on the pace that we're running right now. We are running about 10 million tons on our new crop export book below where we were last year. So it makes sense for them to come in here and adjust that lower. They did reduce crush a little bit by 10 million bushels. And they left the yield unchanged. And Reuters does their survey of the estimates before the report, and 12 of 19 analysts that were surveyed were looking for lower bean yields, and that did not come to fruition. So I think the whole thing together definitely was not friendly compared to what the trade was looking for ahead of the report.
So, Brian, what do you think this means for prices, and talk about technical action here today, because it doesn't look good from this point, does it?
No, so what we're looking at, if you think back to the June highs that we had, and that was in the excitement of the dry weather that we were having before rains arrived, the high that was made in June on November soybeans was 1378. Now, we did trade above that the day after the acreage and stocks report at the end of June, but we closed back below it again. We made our way back to about 1315 and a half, and then the high this morning, or actually overnight before the report numbers were released, was 1378. So again, the same high as the high back in June. So I think that really solidifies resistance up here. Yesterday's low on beans was 1344. We're trading below that right now, and we'll see if we close below that. If we do, that's an outside day lower on the bean chart, which would be also seen as a negative indicator. Any follow through below 1315 and a half will bring in additional selling, and we're likely to retest the levels that we were trading at before the acreage numbers came out, and that was just a hair below the 1260 level.
Gotcha. What about corn? We did get the yield decrease, at least some yield decrease by 4 bushels per acre. Ending stocks almost essentially the same as last month, though, right?
Yeah, so, I think we had the idea that yield could go down, but ending stocks really not changed drastically because of the extra acres that were put into the balance sheet. And we know that from the report that we had on June 30th. So those acres transfer over to the balance sheet. Yield comes down a little bit. They actually increased demand a little bit. They reduced export and they reduced corn for ethanol, but they raised the feed residual, and that's kind of a head scratcher. It must be more on the residual side of things, which I tend to think means they overestimated last year's crop. We track corn for export very closely. We track corn for ethanol. And we know the cattle market's doing what it's doing because there's not a lot of animals being fed out there at this point. So I tend to think that this was an adjustment to the feed residual, more on the residual side and not the feed side. And the only way I can make sense of that is they overestimated last year's crop. And maybe they address that come September. But, as far as post-trade, we had made some lows on December corn the day after 4th of July at 485 and a half. And so we pushed through that. Thus far, we're not really accelerating through it. We're still holding 480, but that might be kind of a key round number where if we start trading below that, you're going to start running some stops. I think anybody that was willing to buy against those 485 and a half lows is probably risking below 480 at this point.
But with what we know about the weather and yield, do you think that it's likely that we'll see yield, production, and ending stocks go lower going forward?
Well, I think the bean crop itself probably has a better chance of getting trend or a potentially above trend yield with a good finish to July and a good August. That's obviously yet to be determined, but at least for right now, the forecast really doesn't look threatening. I've been told from producers that I work with that the bean crop does like to be stressed early. So if you can get those rains to come in, then that plant can really explode and fill the pods out tremendously. But you think about corn, and I don't know. I mean, last year's yield, we're still about 4.5 bushels per acre above that. That's with extra acres, which generally when we plop out extra acres, that tends to have a little bit of a drag on national yield. Then you think about the conditions we had last year, which we had subsoil moisture, and then we got some timely rains. We're definitely getting timely rains this year compared to what we were looking at a month ago. But we really didn't have the subsoil moisture to work with like we did last year. So, I still wonder maybe if the yield doesn't come down a little bit more on corn. But I don't know that it really matters because I still think demand is way too high.
Gotcha. What about the wheat? We did see a bigger production number, a little bit bigger ending stocks on a domestic basis, but the world numbers actually shrank. So how does the market sort through that?
Yeah, I think it's when you got beans down and corn down, the order of the day is sell. I don't think there was anything in the wheat report that was counter enough to what we're seeing in the other two markets to really say, hey, let's jump in and buy wheat. And granted, we already made some lows and rallied off of those lows. So we're kind of just on our way back down. We're going to be dealing with harvest pressure. That's been one of the narratives of potentially friendliness in wheat, is that the harvest is a little bit slower progressing than they'd like. But that just means we're probably going to continue to see some selling as harvest continues. Generally, that's not a crop that a producer is going to store for a long period of time. Maybe it's a short basis play into August. But you're generally going to be wanting to have room in your bins for the new corn and soybean crop coming online. So with corn making new lows, we're just not seeing the export demand for wheat that we need. And maybe we get a little positive volatility here as we start looking at the grain corridor renegotiations. That's due to expire on July 18th. And I don't know, the trend there is that Russia says, no, we're not going to do it. And then right before the deadline, they agree to it. So what we would expect just based on the history, but maybe we get a little bit of volatility pre-July 18th just because.
Yeah, and the thing that you said about demand obviously being slow offsets some of the early yield concerns that we had for HRW. The story still is to be told yet for the spring wheat crop, though. And do you think that we might see some lower production numbers going forward there or not?
Definitely possible. The crop conditions are a concern there. So that's potentially the only bright spot here short term on wheat. We've really determined already the winter wheat yields. It is what it is. It's coming out of the ground. The spring wheat yields are still up in the air. They could get better. They could get worse from here. And that's going to depend on how we finish things out here in the next 30, 45 days. But it's hard to be bullish wheat overall because of one particular variety, put it that way.
And for the livestock producers, you look over at corn maybe being in better supply and better price than last year. And certainly we've already got cattle into contract highs, and this is maybe going to provide a little more incentive to, continue to push that thing, isn't it?
It is. I spoke with another analyst in the industry yesterday. Her name's Susan David, and she had an interesting study she put together. She was just looking at feeder cattle for the year and corn for the year. And the feeder cattle was basically up about the same exact percentage that corn was down for the year. So we're really seeing that inverse relationship. And, we're holding true to that today with corn futures down and both the live cattle and the feeder cattle markets accelerating higher. We've got new contract highs in a lot of different months. And, I've been doing a little charting on the December live cattle, and it suggests we're probably headed up to maybe the 193, 194 area, assuming that the bull flag measurement pans out. So we're likely to see some continued buying, and that might just be a short-term target before we maybe consolidate and figure out a new pattern and go on from there. And I really just think the main risk on on the protein market right now is probably the economy, but stock market is making new highs. It seems to be breaking out above some of these short-term downtrends. So at least, if you're using the equity trade as a general gauge of the sentiment of how things are going, money continues to plow in there.
Absolutely. And CPI was friendly this morning as well. So I think that's also going to help. All right. Thanks for joining us, Brian Splitt with agmarket.net. That's Markets Now.